I'm at REITWorld 2011, NAREIT's annual convention. We're here in Dallas, and joining me is Jonathan Morris, Managing Director with Jones Lang LaSalle. So Jonathan, if you had to sum up the listed REIT market for 2011 so far in one sentence, what would that be? And looking at 2012, what do you think the main story will be then?
I think defensiveness through most of the year was evidenced by the public REITs. They really held their ground for a good 8 or 9 months. When the Dow and the major indices started to drop significantly, yes, they got hurt. They've bounced back since then. The second part of that, I would say, is consistency. They've generally been very consistent in their business plans. They've been acquiring assets when it made sense. They've been refinancing debt when it made sense. And the vast majority of them have taken advantage of this tremendously low interest rate environment. With respect to 2012, I see a lot of the same. Rates are low. I think they'll continue to stay low, and I think REITs will look at debt as being accretive by virtue of the fact that they can refinance at lower interest rates, whether it's unsecured or secured.
Now, looking at the IPO market, it's been, fairly stagnant, and those companies that have come public this year have kind of, underwhelmed for the most part. What do you think it would take to jumpstart the IPO market? The
first new class of REITs, starting with Kimco in '91, I was with Charles E. Smith in '94, Carr, Beacon, et cetera. They came out of storied, long relationship, long in-place development management companies. And there are those companies around in private form today, but they've looked at the REIT format and for various reasons have decided not to become a public REIT. A lot of it has to do with succession issues, whether they have family or executives available to take over. They don't necessarily feel like they have to be in the public domain. So you're not going to see a lot of companies going public as REITs in that genre. The other aspect of it is interesting. When I was part of the '94 class, when we went public at Smith, and the sales pitch was about 50% institutional and 50% retail. So on our book, we would have the institutional bankers, Merrill Lynch, Goldman, et cetera, and then we would have the regional guys. And the regional guys played a very important role because they put the stock in the hands of the retail investors. That's changed a lot. The mutual funds are buying a significant amount of REIT shares. They've grown very, very large. So you're not seeing the bankers rush in and say, we can sell this retail. It really needs to play to the institutional investors. They're very scientific about what they want to buy, what the track record is, what the inside ownership is. If you can meet those metrics, you can probably go public if you have a good portfolio. If you can't, it's going to be tough.
Earlier this year, news was made with the A&B Prologis deal. What's your outlook for, the likelihood that there'll be any additional public-to-public REIT mergers, and are there any sectors in particular that might be more prime for that?
I think the healthcare industry makes sense because those are long-term net leased assets. They're very financeable. The more, the better. You drop down to office, not as much. You have the gateway city public REITs, you have the suburban public REITs, you have the development public REITs. They don't sort of match up. Having said that, something could happen in that space. The apartment REITs are doing great. I mean, their cap rates are low. They're having a field day. They're building as quickly as they can. M&A is going to be a very specialized situation. It's not going to be en masse, and it could happen. People may be planning them today. I don't know.
Great. Certainly quite a bit for us to watch. Jonathan, thank you very much for joining us.
Thank you very much for having me.
For more on this and other news and analysis from REITWorld 2011, be sure to visit REIT.com.